Welcome to the Deep Dive. We're here to cut through the noise and get straight to the insights that matter. Today, we're plunging into the latest numbers from Tata Consumer Products Ltd. You probably know them: tea, salt, coffee staples, a huge name. We're looking at their first quarter results for fiscal year 2026, the quarter that ended June 30th, 2025. Our mission: to really get under the hood of these financial reports the investor calls, pluck the key takeaways, maybe some surprising bits, see how this consumer giant is handling things like market shifts, commodity costs, consumer habits, and, what it might mean going forward. Okay, let's unpack this. Starting with the big picture, the top line numbers. Consolidated revenue for Q1 FY26. RSS, 4,779 crores. That's up a solid 10% year over year. 9% if you look at constant currency. Sounds pretty strong, right?
It does sound strong, but what's truly insightful here is the balancing act they're performing. Because while revenue grew like that, consolidated EBITDA actually declined by 8%, down to R1215 crores, and margins that contracted by 250 basis points, so 2.5 percentage points, down to 12.9%. So that margin squeeze, that's the immediate challenge, you see. Profitability didn't quite keep up with that sales growth.
That is an interesting paradox. Strong revenue, but EBITDA, a key operational metric, heading the other way. What's driving that? Is it just a blip or something more structural, maybe?
Well, it seems like a mix. The management, they put a lot of it down to tea costs, specifically in India, saying that accounted for about 160 basis points of that EBITDA decline. So a key ingredient gets much more expensive, it hits your margins directly, and the rest. Mostly down to coffee prices correcting in their non-branded business. That created this kind of trailing inventory issue, basically selling stock they'd bought at higher prices when the market price was falling. Really shows you how tricky managing commodity volatility can be.
So they're getting squeezed from both sides in different areas, rising costs for tea, falling prices for coffee, impacting that non-branded stock. Wow. Makes you wonder how agile a company this big can actually be, right? But okay, despite that EBITDA pressure, the bottom line looked better. Group net profit was Rs 332 crores. That's up 15% year over year. And EPS grew 12%.
Yeah, and part of that improvement on the net profit line was also helped by having no exceptional items this quarter, unlike previous periods where they had, high interest costs from bridge loans for acquisitions, so a cleaner profit number this time.
Okay.
And, tying this back to the bigger financial health picture, the company's reporting about Rs 400 crores in net cash now as of June 30th, which is a really significant turnaround. They were negative cash this time last year before they did that rights issue.
Okay, so a healthier balance sheet definitely helps.
Absolutely. Gives them more flexibility.
So with that consolidated view, revenue up, but profit under some pressure, let's dive into the core, right? The India business. That part saw really strong double-digit growth, up 11% year over year. What's firing on all cylinders domestically?
Well, let's break it down. If you look at India packaged beverages first, revenue grew 12%. But here's where it gets a bit more nuanced. Volume growth was only 1%, kind of modest.
Only 1% volume. Okay. And wasn't there something about tea market share?
Yes, exactly. A surprising point was an 80 basis point decline in tea market share, according to Nielsen data. But, and this is important context, the management had, let's say, a nuanced view on that data.
Nuanced how?
They mentioned recent year indexing and data sharing challenges with Nielsen's panel. Basically, they seem to suggest the way the data is being collected or reported might have changed, making those direct comparisons, or maybe the absolute accuracy right now, a bit questionable in their eyes. So yeah, a number to watch, but they're signaling maybe don't read too much into just that figure.
Okay. A critical detail there. But still, that reported decline, even with caveats, combined with flat volumes, it does raise questions about the core tea segment. So how are they fighting back against those rising costs and the flat volume picture in tea?
Yeah, that's the key strategic question. They're really pushing premiumization. So Tetley introduced these Slim Care and Booty Care green teas, enriched with L-carnitine, biotin, adding functional benefits. They also mentioned they managed to pass on about 70% of the tea cost increases to consumers.
Okay.
And they expect the gross margins in tea to get back into their target range, 37%, probably by Q3. So it's about getting more value per sale.
Right. And what about coffee in India? Totally different story there, I gather.
Oh, completely the opposite. India coffee was incredibly strong, revenue up 67%, volumes up 33%.
Wow.
Yeah, that's a big win. A real bright spot in the India beverage portfolio.
And the ready-to-drink or RTD side?
RTD. Volumes grew moderately, about 3%, but revenue actually went down 13%.
Tell me.
Well, a couple things. Unseasonal rains apparently had an impact, but also, significantly, a strategic price change. They re-indexed the price, dropped it from Rs 820 to Rs 650 per unit back in Q2 of last year. So they're kind of cycling that price cut now. Management thinks volume growth should start translating better into value growth going forward.
I see.
Oh, and Tata Copper plus water, that grew our revenue 11%, so that was solid.
Okay, good context. Let's pivot from drinks to food then. The India Foods business, also strong, 14% revenue growth, 6% volume. What stood out there?
Tata Salt.
Right.
Just keeps performing. Revenue up 13%, volume up 5%. They hit their highest ever quarterly tonnage. And they refreshed their branding, too, with that Namako Tata Ka 2.0 campaign.
Right.
Plus, the value-added salt portfolio, the premium stuff that continues its strong run, grew 31%. Impressive.
And Tata Sampan, the pulses, spices, etc.
Sampan also going strong, 27% growth. But what's really exciting there, I think, is dry fruits and cold-pressed oils. Management noted dry fruits are now tracking at an annualized run rate and ARR of about 200 crores.
200 crores ARR for dry fruits. Okay, maybe still small overall, but that's significant growth in a category like that.
Especially online, right?
Exactly. E-commerce is driving a lot of it. And they highlighted this lack of trust in the unbranded dry fruit market. That's a really profound insight, isn't it? It shows how much a trusted brand like Tata can win just by offering reliability in these fragmented categories.
Yeah, absolutely. Selling trust as much as almonds.
It could be a blueprint for them elsewhere, leveraging that Tata brand equity.
Okay, now for a crucial bit. The newer growth engines. Capital Foods think Ching's Secret, Smith & Jones, and Organic India. They grew 10% combined in the quarter, which, sounds okay in isolation, but it's way below their target of 30%.
Yeah.
So what's the deal here? Just integration hiccups.
Management called them transitory issues. For Capital Foods, a big one was capacity constraints, especially for noodles. Sounds like they misjudged demand for the smaller 10 and 15 rupee packs and just couldn't make enough fast enough. Needed time to get new lines running.
Operational challenges. Anything else? Yeah, some supply chain stuff too. Hiccups with exports blamed partly on geopolitical issues in the Middle East. And issues with some imported ingredients vaguely linked to the China story.
The China story, meaning supply disruptions, cost changes.
Probably all of the above. It meant they had to rejig some recipes, right-size inventory. So yeah, not just minor glitches. It points to the real challenges of forecasting, scaling, and managing global supply chains when you're integrating fast-growing acquisitions. It's proving complex.
But it wasn't all gloomy for the acquisitions, right? Organic India had some bright spots.
Definitely. Organic India's e-commerce revenue shot up like 3.5 times year over year. Huge growth online. And they brought Sachin Tendulkar on board as a brand ambassador, aligning with that quality and trust message.
Makes sense.
Plus, the pharmacy distribution channel is expanding well, now reaching the top 40 cities, apparently getting good traction there. So, progress is being made, even with the overall growth number being a bit soft.
Okay, let's turn our gaze overseas then. The international business. Maintain momentum, 5% constant currency revenue growth. Where does that come from?
Mostly the USA. Really strong coffee performance there. Revenue up 20%. And their brand, 8 O'Clock Coffee, gained market share, both in bags and K-Cups. That's a solid win in a very competitive market.
Good to see. What about other key markets like the UK and Canada?
A bit softer there. UK revenue declined 7%. They said it was mainly due to shifting promotional timing compared to last year and cycling a strong quarter previously. Tetley did hold on to its market leadership, though.
Okay.
And Canada was similar, down 4%. Also attributed to shifting promotional timings with the big retailers, so timing and comparisons were a big factor.
Got it. Now, what about the joint venture Tata Starbucks? Always interesting.
Yeah, always. They added 6 net new stores, so the total is up to 485 across 80 cities now. Steady expansion, same-store sales growth, positive overall for the quarter. But they did see a dip specifically in May.
A dip?
They attributed it to about 10 days of impact from what they called geopolitical tensions. Mentioned something called Operation Cinder in North and Northwestern India. Sounds like localized unrest or events that forced some stores to reduce hours or even close temporarily in certain areas shows how even these macro regional things can ripple down to retail operations.
Yeah. Interesting connection.
But despite that blip, growth drivers like cold brew and those Gen Z-focused refreshers apparently continued to do well.
Okay, let's touch on one more segment, the non-branded business. Often overlooked, but important, grew 7% revenue. But like some other parts, profitability took a hit here too.
Yes, exactly. And that goes back to the coffee prices we mentioned earlier. The drop in global coffee prices was the main culprit here, that trailing inventory effect again, selling coffee beans they'd bought earlier at higher prices into a falling market. Squeezes your margin.
Right, like trying to sell winter coats in spring.
Precisely. Management thinks it might take another quarter for that impact to fully wash through, but they expect stabilization. They've been working on optimizing sourcing and managing the inventory.
Okay, so looking beyond specific segments strategically, what are the big priorities? They seem really focused on distribution and channels.
Absolutely. Omnichannel is clearly huge for them. E-commerce channel grew, what, 61%? Massive. Modern trade, up 21%. And they're building out newer channels, too, like food services getting into large accounts, premium hotels.
And the pharmacy rollout you mentioned for Organic India.
Yeah, that's progressing.
Yeah.
Expanding to 40 cities. And they've apparently installed around 5,000 vending machines for bean-to-cup coffee, giving them, they claim, about a 5% share in that specific market already.
Wow. Okay, so lots of focus on reaching the consumer in different ways.
Definitely. And just to add another strategic point, they highlighted progress on sustainability, too. Their ESG ratings improved. Got a strong rating, 61 out of 100 for FY25, up from adequate before, so showing commitment there, too.
Good to note. And just circling back one last time to commodity prices, the outlook.
Well, for tea, particularly North India tea, prices are actually moderately lower now, about 9% lower year over year for July month to date, and management expects them to trend lower still. So they believe tea gross margins should get back to that target 34-37% range by Q3.
Okay, some relief potentially on the tea side.
Potentially. Coffee prices, though, still volatile. That remains a bit of a wild card. Really underscores how much these global commodity swings affect even a giant like Tata Consumer.
Absolutely. So let's try and wrap this up. Our deep dive into Tata Consumer Products Q1 FY26. The takeaway seems to be robust top-line growth, driven by the core India businesses, especially salt and sampan, and strong international coffee. But profitability definitely felt the pressure from commodity cost tea going up, coffee coming down, impacting inventory, and those transitory issues in the newly acquired growth businesses. Still, management seems to be strategically adapting, managing inventory, pushing premiumization, and really doubling down on expanding distribution through all these channels. It feels like a story of resilience, really.
I think that's fair. And stepping back, you really see them navigating a pretty complex environment, right? The commodity landscape, the challenges of integrating those big acquisitions. But their underlying strategic pillars, like the omni-channel push, the focus on premium products, they continue to show real promise. It feels like a company leveraging its core strengths while trying hard to adapt to a very dynamic world.
And maybe that leaves us with a final thought for you, the listener. You've heard how all these external factors, commodity prices swinging, wildly unexpected rain, even geopolitical tensions in a specific region can directly hit a company's day-to-day results. It really raises a big question, doesn't it? In this super interconnected, sometimes unpredictable world we live in, how much can a giant consumer goods company truly control its own destiny? And how much is it about being really, really agile and responding to forces that are ultimately outside its control? Something to think about. Thank you for joining us for this deep dive.